Welcome to this segment of GTM Training Shorts presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what are the tax consequences of stock options? Listen to Michael Bowman, Director and Ohio Regional Office Lead, as he explains.
What are stock options? Stock options are a benefit given to an employee which enables them to buy stock at a locked-in or set strike price. Options typically come with vesting conditions. There are two basic types of stock options: incentive stock options and non-qualified options. Stock options that meet the detailed requirements of IRC Section 422 are termed incentive or qualified stock options. Of note, ISOs can only be issued to employees and can't exceed $100,000. The key benefits of an ISO are the employee may defer recognition of income until the option is sold and recognize 100% capital gain upon sale or disposition, rather than part ordinary income and part capital gain. The key detriment to an ISO is that the employer is not entitled to a tax deduction unless there is a failure to meet certain holding period requirements. If a stock option is not an ISO, it is a non-qualified option. The basic operation is that an employer deduction is linked to the timing for income recognition of the employee. The employee will generally recognize income at the time of exercise equal to the difference between the fair value of the stock at the exercise date and the exercise for strike price. To expand on that point, in general, the Treasury regulations allow an employer to deduct the value of a non-qualified stock option without a readily ascertainable value in the tax year that the employee includes the amount into income, which is the tax year the non-qualified stock option is exercised. If the non-qualified option has a readily ascertainable value, then the employee includes the non-qualified option into income when the non-qualified option is granted, and the employer is allowed a deduction in that same year. Generally, non-qualified options will only have ascertainable fair market value when a market exists for their trading. Since this is typically not the case, generally, the discussion of tax consequences is in the context of exercise rather than at the time of granting. Another important note, the locked-in price is theoretically a benefit if we assume the stock price will increase. One could have a situation where the stock price decreases over time. The condition where the stock price is lower than the exercise price is termed underwater. In these cases, one would not exercise the option, opting instead to buy the stock on the open market if they desired. But all is not lost. Most awards have a term of 10 years, but only a vest period requirement of 3. As such, there's potentially 7 years where you could wait out the market. Here's a list of useful terms applicable to share and option awards. The grant date is the date the award is granted to an employee by the company, as opposed to the vesting date, which is the date there's no longer any restrictions to an employee's ownership of the stock. Also commonly described as the date when there is no longer a substantial risk of forfeiture. That risk refers to the risk that a particular benefit might not be conferred to an employee due to failure to achieve specific conditions of an award, such as service period, performance, or market conditions. The exercise or strike price is the price an employee must pay to exercise the option to purchase stock under a stock option award plan. And lastly, the disposal date is the date on which the stock is sold or otherwise transferred by an employee. The tax consequences of stock options can best be summarized by an example. So assume the following. An employee is granted an option to purchase 1 share of stock for $10 at any time over the next 10 years. At the time of grant, the employer's stock has a fair market value of $10 per share. The option vests at the end of year 3 in cliff vesting. The employee exercises the option in year 7 when the fair market value of the stock is $50. The employee later sells the stock in year 9 when the fair market value of the stock is $70. Given the prior assumptions, below is a table comparing the tax consequences for a typical ISO and non-qualified stock option. Now, on the left-hand side of the table, you'll see the incentive stock options. The key benefits of an ISO are the employee gets to, 1, defer recognition of income until the option is sold, and 2, recognize 100% capital gain rather than part ordinary income and part capital gain. If you recall, the key detriment of an ISO is the employer does not get a tax deduction. So looking at the table, you have non-taxable events at the grant date, vesting date, and exercise date in the case of an ISO. The first and only taxable event occurs in year 9 when the individual sells the stock when it's got a price of 70. So if you think about it, they exercise the option and bought the stock at 10, so that cash outflow, and they bring in cash of $70, so they have a realizable and recognized gain of 60, and in this case, it's capital gain given it's an ISO. And note, none of these situations is there a taxable event for the employer, so they get no deduction. On the right hand of the table, you see the non-qualified option. There is no taxable event at the grant or vesting date. The first taxable event occurs at exercise in year 7. So the individual exercises the option, buys the stock at 10, at a time when the fair market value of that same stock is 50. So they realize and recognize a $40 tax. And that income is ordinary in nature. Because the employee has picked up $40 of ordinary income on the W-2, the company can then take the corresponding $40 deduction on its business tax return. And then later in year 9, individual disposes of the stock. They get proceeds of 70. The previous time point at exercise was 50, so they realize and recognize a $20 gain. And this time, because they've held it for more than a year, it's capital gain. And similar to the ISO situation, there's no taxable event for the employer, so they do not recognize the transaction based on the private nature of that sale.
For more information on the tax consequences of share-based compensation awards, check out our Corporate Income Tax Compliance Fundamentals 2 program. Scan the QR code or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.